This week it's been all green so far. What's your perspective on the markets at the moment?
Well, the market at the moment, the real big story was the Dangote cement listing yesterday, which at 135 naira a share, some analysts thought was a bit overpriced, but it seemed to have gone down quite well in the market. And also, I think another story we're following is also Cadbury, which has returned to profitability after about 3 years of losses, which is another good feel-good story for the Nigerian market.
Let's hone in on Cadbury there. I mean, as you say, the markets seem to now be more convinced by the group's turnaround over the past 2-3 years. What's your view on the stock and its ability to sustain the kind of momentum it's managed to harness?
Well, Cadbury is coming from, in 2006, there was a financial misstatement in his accounts, which it had to restate his accounts. During that period, there was a restructuring internally within the firm. Cadbury UK came to take a firmer control of the company and try to restructure it. And what we saw there was, during that period, 2006 to 2009, there was strong sales growth, but not profitability. But what we've seen now is that with their rights issue last year, they paid down the debt after the company is basically debt-free. They've now concentrated on their main lines, which are like Bonvita, with Bonvita, TomTom, Buttermint brands, and they've seen return to profitability as their efficiency in the factory has also improved.
To what extent is this standing as a beacon of example in terms of the fact that turnaround strategies can be effective if implemented correctly in the first place, and proving somewhat of a lesson for the banks and the distressed banks specifically right now?
It's a good sign. It shows that with focused management and focused restructuring, you can turn around a bad position to a good one within a pretty short period, which is 3 to 4 years. And Cadbury has shown that it can be done because from the period they're coming in 2006 to where they are now, and the growth potential going forward, especially in the fast-growing food and beverages section, has shown that there is some hope if we can get focused management with strong regulatory oversight for the rescued banks.
Well, that is the potential that we're looking at. For now, there's still some caution about, and to note with the banks is that, while we have confidence slowly seeming to be creeping back in here, revenue growth is still actually for the most part negative. Yes, profitability is there, but that more a case of less provisioning than actual revenue growth is starting to filter through. So how are you viewing the sector as a whole at this stage?
Well, the sector as a whole, I mean, what we're really seeing, you're right, revenue growth. I mean, even the strong banks like Zenith and GTB, when they're showing the results, are showing an average of about 13-14% drop in revenues, while profitability is increased. Usually due, as I said, to less provisioning, as well as increased efficiencies as they try to slim down their operations. Now, going forward, without that growth in revenue, which many people see in terms of slowdown in the dispensation of loans to the market, we can't really see growth in the medium term increasing, because if you don't give out loans, how are you going to make money? The usual, over the last year and a bit, what the banks have done in liquidity situation is buy government bonds. But we've seen the yields on those assets have dropped far below than the drop in the cost of funds. So they have to start lending to the sector to have real growth going forward.
Yeah, looking at that and that being the case, I mean, what would be a stock pick for you within that territory?
I think GTB and Zenith Bank have shown with their Q3 results and over this trying period that they have a very strong franchise. Especially GTB and Zenith are concentrated on the high-end corporate sector, so their risk assets are pretty solid, pretty good for the corporate sector as a whole. Their NPLs are in single-digit figures and seem to be under control, and their costs are also around around the 60% mark, which is pretty good for Nigeria. When you have the likes of rivals like UBA, which have a cost-income ratio of over 80%. And so when you look at that, I think those two going forward seem to have the right management strategy in place to actually take a leading position when lending resumes in the market.
On the flip side, which banks are you staying clear from at this stage, and wouldn't be touching with a barge pole at this stage?
Well, the banks I'm a bit dubious about their strategy going forward, to be honest, are the likes of UBA. I mean, UBA is a big bank, and when you look at the Q3 results, GTB and Zenith doubled their profitability. And when you have cost-income ratios of about 80%, above 80%, you have to ask questions. Now, when UBA is excuse is that they're doing African expansion. But if you look at the African expansion, it was really hard to see how expanding in countries like Burundi, Rwanda, which are very low GDPs, in terms of overall size, how that's going to affect the bottom line. And when you look at dissect their figures, still 90% of the revenues and income is from Nigeria. Although the rest of Africa is increasing at a decent rate, it's hard to see, because if you even look at the rest of Africa, they make 50% of their outside Nigeria revenues in just 2 countries, and that's Ghana and Burkina Faso.